Hello, everybody. Here we are. Seems like a while since we've had a lecture. If you're watching this, then hopefully you have taken your fourth test over chapters 8, 9, and the first part of 10. So that should be completed. And now what we're going to do is continue on. We don't have a whole lot left in this class, but we have a handful of lectures here. So let's go ahead and start today. Obviously, since we're just coming off taking a test, there's no homework to go over, so we'll go right into lecture. I'll try to break it up a little bit with some maybe some in-class stuff. So going to the PowerPoint, the PowerPoints that are available for you on Angel are the Chapter 10, excuse me, Part B PowerPoints, okay? So hopefully you have those in front of you. And let's just do a little bit of review. Some of these slides you've seen before, but let's kind of shift back into the Chapter 10 mode. Chapter 10, we're talking about plant assets. These are those large fixed assets that are tangible in nature and used in our operations. They provide benefits for a number of periods, not just 1 year, but beyond that. Sometimes we call them PP&E, or property, plants, and equipment. We're going to talk about, or we've already talked about, how you record fixed assets when you acquire them. We talked about some of the things that you do during the life of the asset, like depreciation. We lectured about that and learned about that before the test. We're going to talk about accounting for subsequent expenditures today. And then eventually we're going to talk about when we dispose of assets. Now, we talked about what depreciation is. And some people missed this on the test, but I had a test question that said depreciation is, and one of the incorrect options was to record the decline in market value of an asset. That sounds so good, but it's wrong. Depreciation, the purpose is not to record market value depreciation, because that's a completely subjective notion. What we're doing is just simply spreading out the expense over the number of periods, okay? So it's a way to spread that asset out over the income statement as an expense, okay? But it is not an attempt to write down an asset to its market value, okay? And then we learned about these three types of depreciation methods. Those were on your test. And we talked about sort of the difference on that, as far as straight line gives the same amount each year, units of production, on the top right there does a different amount depending on whatever you produce. And then the double declining balance method depreciates more in the early years and less in the later years. Okay. Now, one thing I want to mention real quickly, we don't talk a whole lot about taxes here, but I at least want you to know this term. There's something called MAKERS, and that stands for Modified Accelerated Cost Recovery System. And that's just a way that the tax allows you to write off an asset more quicker, is that a word? It allows you to write off a fixed asset quicker. Why would you want to write off your asset quicker? Get it expensed quicker? Because it's going to reduce your taxes, right? Okay. You'd rather expense it as quickly. I mean, you know, keep in mind, a company would like to, they wish they could completely expense their assets in the year that you get them, so that they can reduce their net income and reduce their tax liability, okay? But while we're not allowed to do that, the Modified Accelerated Cost Recovery System does allow for more rapid write-off of those, okay? Now, what about partial year depreciation? Now, we talked in all the examples that we did before the test, I think we always purchased the asset on January 1 or January 2, right? Okay, that was because we didn't want to really get into that. But obviously you buy assets all throughout the year, not just on January 1st. And so what do we do when we acquire an asset during the year? Well, we just depreciate it for that first year for the portion of the year in which we owned it. And I think this is pretty much follows common sense. Example, how much would we depreciate for 2011 if we acquired equipment on September 30th of 2011? And the equipment cost $85,000, has a useful life of 10 years, and an estimated salvage value of $5,000. Well, using the straight line method, we would take the cost of $85,000 minus the salvage value of $5,000 divided by 10 years. That would be how much, and that would give us $8,000 depreciation for a full year of depreciation, right? But for 2011, we only had it for 3 months out of the 12, right? For October, November, and December. So what's 3/12 for times 8,000? We depreciate 2,000 for 2011. Of course, in 2012, it was out in operations for all 12 months, so we would depreciate 8,000. But in that first year, it would just be 3/12 times 8,000. Make sense? Not too hard there. What about changes in estimates for depreciation? Now, although the cost of an asset is known and objective, the predicted salvage value and the predicted useful life are estimates, right? What if you gain more information over the course of that asset, over the life of that asset, that indicates that your estimates maybe weren't the best? Well, what we do is, let's look at an example. I think this will be best illustrated with an example, okay? All right, let's take a look at this. On January 1 of 2009, we purchased equipment that cost $30,000, had a useful life of 10 years, and no salvage value. During 2012, the useful life was revised to 8 years total, which would be 5 years remaining since 3 years had passed. What's our depreciation expense for 2012, the year ended December 31, 2012, using the straight line method? Well, first of all, what we need to do is recognize that the equation that we're going to use is thus. We're going to take the book value at the date of change. And do you remember what the book value is? What's book value? Somebody make me proud. What? Thank you, Allie. Book value of an asset is cost minus accumulated depreciation. So we're going to take the book value at the date of the change. We're going to subtract the updated salvage value. And then we're going to divide it by the remaining useful life. Okay? So first thing we have to do is figure out what book value is. Okay? Now, this asset originally was a cost of $30,000 with a 0 salvage value, and we had it for an estimated life of 10 years. So we've been depreciating $3,000 per year, right? Correct? And we've done that for 3 years. So our accumulated depreciation at December 31 of 2011 is $9,000, correct? $9,000. So our book value at the date of change is $21,000, right? Isn't that our book value at the date of change? $21,000, cost minus accumulated depreciation. There's no salvage value on this example, so we just divide that by the remaining life of the asset. They changed it to 8 years total, but 3 of those have gone by, so there's only 5 years left, which means we're going to depreciate $4,200 for 2012 and each year beyond. We're not going to go back to previous years and change anything, but this is how much we're going to depreciate per year from here on forward. Does that make sense? Okay. Any questions on that? We divide it by 5 years left.
Oh, okay.
Okay?
Yep. Thanks.
All right, now let's talk about what depreciation kind of looks like on a balance sheet, okay? And this is, just want to point this out real quick. A lot of times they won't put accumulated depreciation after each category. They'll just give you the cost of your assets in total, like in this case it's $575,000, less accumulated depreciation for everything, and then that gives you your net property, plant, and equipment. Okay, so that's how it might look on a partial balance sheet. All right? Okay, next thing I want to talk about, and this is actually at the beginning of your chapter, okay? So if you're looking around in your book and you're like, I cannot find this, look in the very first few pages of your chapter. But I always put this off until after the test because I'd rather concentrate more on depreciation subjects, okay? But now let's take a look at lump sum purchase. And this is something that's going to be best learned by doing an example. But let's read this. Okay, let me back up a little bit. Let's go ahead and come off the PowerPoints there. Let me introduce this to you a little bit. There's a lot of times we're going to make a purchase in real life, and you purchase a number of fixed assets with just in a lump sum. Okay? And this could be like if you buy a business, or if you buy some property and it has equipment on it or a building on it or something like that. But a lot of times a lump sum purchase occurs, and that's just when you buy a number of fixed assets and you just know the total of what you paid for all of it. Okay? Now going to this PowerPoint, you're going to see that what we're going to use to allocate this is the relative market values. Let's look at an example. I think it'll make more sense. On January 1, Matrix Inc. purchased land and buildings for $200,000 cash. Now the appraised values are building 162.5 and land 87.5. Okay, how much of the $200,000 price will be charged to the building and land accounts? Okay, so look at that slide. Look at that middle paragraph again. We purchased land and building for $200,000 cash. The appraised values for the building is 162.5 and 87.5. Now those are the appraised values, right? So let's think about how we would do this journal entry. Okay? Now, we know that we paid cash of $200,000, right? We know we paid cash of $200,000, correct? So how are we going to record the rest of this journal entry? Well, let me show you some things that would be wrong. You couldn't make up an asset called land/building or land and building and debit it for $200,000, could you? Why could you not do that, curiously? Anybody know? Well, one reason is do we depreciate buildings? Yes. Do we depreciate land? No. So you can't do that. That's not an option. Okay? Now we saw on here that the appraised values for the building was 162.5 and the land was 87.5, right? So somebody might say, well, you could debit building for 162.5 and land for 87.5. Was that the appraised value? Let me double check. Yeah. But that's not what we paid for it, is it? What did we pay cash-wise? $200,000. And somebody said, well, maybe you could record a gain or something. No, you can't do that. You cannot record assets at something that you didn't pay for. We didn't pay that for it, did we? Okay? Now somebody might say, well, you could just say, we know we paid cash at $200,000. You could just say, we know we have to list these separate. You could just divide it up like that. Well, no, we're not going to do that either, because that's just making some sort of allocation evenly, and we don't know if that's the case or not. Okay? So you see our dilemma? We can't violate the cost principle. The cost principle states that we paid $200,000 cash for these assets. So by golly, the total of these need to be $200,000 when it's all said and done. Well, how are we going to do this? Well, we're going to use those appraised values. We're not going to record the assets at the appraised values because that's not $200,000, but we can use that in our allocation process, and here's how we do it. Whoops. We take those appraised values, okay? Let me get my pointer. We take those appraised values for the land and the building of 87.5 and 162.5, and we recognize that the total of that is 250. Well, 87.5 divided by 250,000 is 35%. 162.5 divided by 250,000 is 65%. So then what do you think we're going to multiply those by? The $200,000 cost. And then that gives you the apportion cost. And that's what the assets will be recorded at. The land will be debited for $70,000, and the building will be debited for $130,000. The total assets will be $200,000, and that's what we paid for them. But that's how we divide it out between the land and the building. We just simply use those appraised values to allocate that purchase price. Does that make sense? And you might do some rounding there. These were pretty clean and even numbers. But if it's not, you can do some rounding there. But you need to make sure that when you add these together that it equals 200,000, or otherwise your journal entry is not going to balance, is it? Okay? Okay, any questions on that? All right. Well, we're kind of jumping around a little bit. This is just kind of a mixture of fixed asset sort of topics, somewhat related but somewhat unrelated. Now let's talk about, going to the PowerPoint, what about additional expenditures? Now, during an asset's life, we're going to have expenditures in regards to that asset, right? Any of you who drive a car, which is probably all of you, know that during the life of that car, there's going to be expenditures related to your automobile, correct? That's that way too. I mean, and automobiles are an example of a fixed asset for a business, right? You can see the picture there is a city bus, and it's up on a lift, right? Okay? And I mean, think about it. If you had a bus in your business, there's times that that's going to have to be worked on as well, correct? So we know that there's additional expenditures, and not just in regards to automobiles, but in regards to buildings and all sorts of stuff, okay? Equipment, forklifts, conveyor belts, whatever. Okay. Well, there's mainly two types of expenditures. There's what we call a revenue expenditure. And this is an expenditure that's an expected and normal repair that's going to maintain operating conditions. Okay? It does not increase the life of the asset or productivity of the asset beyond what our original estimate was. Okay? Now, what's key is when incurred, an expense account is debited. We just expense this. Okay? And you can see the picture there on the PowerPoint is of some oil getting changed, right? Now, if you have a company vehicle, an oil change is something that is just, when you guesstimated your original life of that asset, you were assuming that you would get oil changes, right? Okay? So that would definitely be something that you would just expense. Okay? Now, coming off the PowerPoint, and well, keep on the PowerPoint one more, I'm sorry. It's sometimes weird that we call this a revenue expenditure. It seems like we should call this an expense expenditure because we expense it, right? It's not a revenue, but that's what they're called. They're called a revenue expenditure. It gets immediately expensed on the income statement, okay? But it's, like I said, it is expected and normal, and it doesn't increase the life of the asset or productivity of the asset beyond what we originally thought. Okay? Coming off the PowerPoint now, can you think of some different revenue expenditures for different fixed assets? We said an oil change. Can you think of any more for an automobile?
Tire rotation.
Tire rotation, very good. Adjustment of brakes, right? Okay? Maybe a tune-up occasionally, right? Those are just expected things that you have to do. What about if you owned a building? Think about the building you're sitting in for JCCC. What are some of the normal expenditures that a building is going to have? You have to replace the doors every now and then, yeah. Clean the windows, right? How about replace the filters in the furnaces? Okay.
Light bulbs.
Change light bulbs, right? These are just normal things, right? Okay.
Like janitorial.
Janitorial, yeah, that would be something that's expensed. But you're right, that's something that's necessary to keep the building in operating condition, right? Okay? All right? So those are some different revenue expenditures in regards to fixed assets. Now let's talk about the next category when we have additional expenditures, and that would be a capital expenditure. A capital expenditure is a major overhaul or a partial replacement. And this is the deal. It extends the life beyond the original estimate, or it extends the productivity of the asset. Okay? Now what's key here is when we have a capital expenditure, we capitalize it. Do you know what it means when we say we capitalize something? That means we debit an asset. Okay? We debit an asset. So when a capital expenditure is incurred, an asset account is debited, and then we're going to depreciate that asset over the life of the asset. Okay? Now, the picture here on your PowerPoint is of an automobile getting a brand new engine block. And I had to do this on one of my automobiles years ago. The engine went bad, and it was a fluke thing, and it was still somewhat of a new car. So I had to get a new engine block. It cost a lot of money. Now, is getting a new engine block in your automobile, is that a normal and expected expenditure? No. No, it isn't, is it? Okay? So that's the sort of thing where you would debit an asset and then you would depreciate it. Okay? Make sense? Now, coming off of the PowerPoint, what are some different, can you think of any other capital expenditures for like an automobile?
You have to replace something.
Perhaps if you had to do some major replacements as a result of a car wreck. Okay? The engine block getting replaced is probably the best example I can think of for an automobile. But for building, a capital expenditure might be, let's say you had to have some major foundational work done. Okay? That's probably not something you would have expected. Okay? Or let's say you build onto a building. Let's say we add on to this building that you're sitting in. Well, that's something that we definitely capitalize. We would capitalize that expenditure. We would debit an asset and we would depreciate that, wouldn't we? Okay? So you see the difference between those two subsequent expenditures? Okay? Now, normally, too, as your PowerPoints will point out, normally, if an amount is not material, the company's just going to expense them. And a company should have what is called a capitalization policy. What is a capitalization policy? A capitalization policy is just something that says, okay, for our business, if something is less than X amount of dollars, we're just going to expense it. Okay? We're just going to expense it. All right? Regardless of the number of years that we think it's going to provide value, regardless of any of that, our capitalization policy is thus. Okay? And why do we do that? Well, I'll tell you why. I went into, coming off the PowerPoint, I went into a business once, and they had purchased some chairs, much like the ones you're sitting in. Okay? Folding chairs. Okay? Well, they purchased they purchased some folding chairs, and I think they paid like $20 for a chair. Well, their rationale was, well, this chair is going to provide benefits to our business for not just this year, but for a number of years, right? So they said, you know, for like 5 years at least. So they were depreciating $4 a year for that chair. Okay? And even more ridiculous than that, they were doing monthly depreciation entries. So they were depreciating, you know what, 33 cents a month? Something like that, silly? No. No. Even though the chair, yes, you're right, it's going to provide benefits for a number of years. But it's less than your capitalization policy amount, which is usually, for this client, I think I established it at $500. If it's less than that, you just expense it. You with me? Make sense? Okay. So every company should have a capitalization policy that makes sense to them. And there's not a certain amount that it always is going to be. What it is for a small bakery versus Sprint is probably two different amounts, isn't it? Okay? Okay, now what I want to do in class right now is let's work on a few things here. Let's go ahead and do... Let's go ahead and just do quick study 10.8. Quick study 10.8. However, I want to change the instructions a little bit. On quick study 10.8, I want you to classify these different things as a capital expenditure or as a revenue expenditure. And then I want you to do the journal entry for each one, A, B, C, and D. Okay? They tell you differently, but I'm changing the directions on quick study 10.8. I want you to classify each one of those and then make the journal entry for each one of those. Okay? Let's go ahead and do that now. Quick study 10.8. Okay, let's go ahead and take a look at that. Quick study 10.8. Okay. All right. A. Completed an addition to an office building for $250,000 cash. Okay. Well, is that a capital expenditure or a revenue expenditure? Obviously a capital expenditure, right? So we would depreciate an asset. How about building for $250,000? Now you might have titled your asset building addition or something like that. The key is that you debited an asset, and you will depreciate that asset. Does that make sense?
Well, but you wouldn't make a new title like building addition because you're kind of just adding it on to the building that's already there.
It's a great question. Great question. What Sarah is saying is, she's saying, which would you do? Would you create a new asset called building addition and depreciate it? Or would you just add that onto the existing building and adjust accordingly? You could do either way. Okay, and I've seen it happen both ways. Excuse me. Let's go through what those ways would be. The first way would be just to have a new asset on your fixed asset listing called building addition. And you just depreciate it like it's almost like it's a separate asset. Okay? But it would be an asset, right? Okay. The second way would be you debit the original name of the building or whatever it's called, and then you revise your depreciation using the rules of depreciation revision that we talked about earlier, where you take the remaining book value minus the salvage value that's most up to date divided by the remaining useful life. Okay? But a lot of people will do the former way, Sarah, just so they don't have to do the revision. You see what I'm saying?
That would be easier though, to add it on to the existing building.
Yeah, then you just have to adjust what you've been depreciating. Either way works. And in the end, the balance sheet and income statement will be the same. Okay? The key is that you don't expense it all. You capitalize it, which means we debit an asset. Okay? Good. Good question. Okay, B. Paid $160 for the monthly cost of replacement filters on an AC system. What's that?
AC expense.
That's a revenue expenditure, right? And, you know, it would just be some sort of expense. Let's just call it maintenance expense. And it was how much? 160? So how's that? Does that look good? Okay. All right, what about C? Paid $300 cash per truck for the cost of their annual tune-up. Well, once again, I think that would be a revenue expenditure. And we would just say, like, repair / tune-up expense. And how much was that? $300 per truck. So we'd have to make that entry for each truck, right? But the key is that these are expensed, right? Okay, what about D? Paid $50,000 cash to replace a compressor on a refrigeration system that extends its useful life by 4 years. That's definitely a capital expenditure, correct? Right? So we capitalize it. That means we would debit something like equipment or compressor or something. And this is what, $50,000? And then we would depreciate that equipment. Does that make sense, guys? For quick study 10.8? Cool?
For C, can you title that maintenance as well?
I don't like D.
For C.
For C?
For
Oh yeah, for C you could do maintenance expense.
You'd still be allowed to do that even though B's maintenance expense? Would you just title like vehicle maintenance?
Yeah, just as long as it's an expense account, it makes sense. Okay? You could do maintenance expense for B or for C. Okay? All right, any questions on Quick Study 10.8? Okay, we're going to go through one last quick thing in Chapter 10 real quick. And I want you to read about this in your book. But let's talk about natural resources, okay? Natural resources. Now, these are long-term assets, but they're not like buildings and conveyor belts and stuff. These are more things that are extracted from the natural environment, okay? These are more Mother Nature stuff. Like if you have an oil field or a coal mine or a gold mine, or if you have a forest that you're going to tear down the trees and make into lumber or something, okay? Those are natural resources, okay? You with me? Now, the key here is we don't depreciate these items. There's not something called depreciation for these items. We use the term depletion for natural resources. So you don't have depreciation expense. You have what we call depletion expense. And you don't have accumulated depreciation. You have accumulated depletion. But other than that, it's pretty much the same. You with me? And a lot of times with natural resources, we're going to use the units of production method to deplete it. Not to depreciate, but to deplete it. And as a reminder, you take the cost minus the salvage value divided by the total units of capacity that you think you'll get out of that natural resource. And then you'll take that depletion per unit times the units extracted and sold in the period. Let's give an example. Apex Mining acquired a tract of land containing ore deposits. This would be an example of a natural resource. The total costs of acquisition and development were $1 million, and they estimate that the land contains 40,000 tons of ore. Now, during the first year, they extracted and sold 13,000 tons. Well, here's what you do. You take the cost of that asset, of that natural resource, minus the estimated salvage value, which in this case is 0, divided by the total amount of tonnage that you think you'll extract from it. In this case, it's 40,000 tons. So what we're going to do is we're going to deplete $25 per ton for the number of tons each period, right? Does that make sense? Now, and this is it, let me actually change this. If it's not changed on your PowerPoint, that's not really 13,000 units, that should be 13,000 tons, correct? Well, we extracted 13,000 tons, and we're going to deplete $25 per ton, which means that we're going to have depletion expense of $325,000 for that period. So we are going to debit depletion expense for $325,000, and we're going to credit accumulated depletion, also a contra asset account for $325,000. Are you with me? So it's not a whole lot different, just the terminology is a little different. And I want you to read about this in your books, but a lot of times too, when we have assets, fixed assets in regards to or in operations with those natural resources, we will depreciate those resources in the same proportion as we are depleting the natural resource. Okay, read about that in your book a little bit. That big truck, that's a fixed asset, isn't it? And we would depreciate it. But the ore mine that it's working on is a natural resource, and we would deplete it. Understand? Okay. Okay, we're going to stop there. We're going to stop right after natural resources. But do read about natural resources a little bit more in your book. We had to go through that a little bit faster than I would have liked, but I think your textbook will fill any holes. Okay? All right, I'm not going to give you too much homework tonight, but I want you to do the following, okay? For homework, I want you to do Quick Study 10.5, Quick Study 10.10, Exercise 10.3, and Exercise 10.9. All right? Okay, guys, we'll see you next time. Bye-bye.